In this video, I'd like to walk you through a few scenarios that illustrate how accruals and deferrals work in practice. We'll begin with an example of an accrual. As discussed in the previous video, accruals involve recognizing revenues and expenses before any cash is exchanged. Recording an accrual in a company's books accurately reflects the occurrence of economic activities, even if no cash has been received or paid at the time. With that in mind, let's dive into the first scenario. Scenario 1. XYZ Corporation needs to accrue $15,000 in salaries for work performed by employees during the period of January 27 to 31. Although the employees have not yet been paid, the company must record an accrual to reflect the time they worked during that final week of January. This ensures the expense is recognized in the correct accounting period. To properly record this accrual, the company will recognize a salary expense and a corresponding liability. Here is the journal entry that reflects this accrual. As shown, the transaction date for this entry will be January 31st, as it represents the last day of the pay obligation period. To record the accrual in the general journal, XYZ Corporation would debit salaries expense for $15,000 to recognize the cost of the services incurred, and credit salaries payable for $15,000 to reflect the company's obligation to pay its employees in the future for work performed during the period of January 27 to 31. This entry ensures that the expense is matched with the period in which the work was completed, even though the actual cash payment will occur afterward. Now, let's move on to deferrals. Deferrals involve recognizing revenues or expenses after cash has been exchanged. In other words, the cash changes hands before the related revenue is earned or the expense is incurred. The recognition of the revenue or expense is postponed until the appropriate accounting period. Let's take a look at the second scenario to illustrate this concept. Scenario 2. XYZ Corporation paid $12,000 in advance to rent a facility for 6 months. In this case, the company has paid for an economic resource that will be used in the future. Although cash has already been spent, the benefit of the rental period has not yet been realized. Therefore, the company must defer the recognition of the expense until the rental period is actually used. To record this deferral, XYZ will recognize an asset, specifically prepaid rent, rather than an immediate expense. This reflects the future economic benefit the company expects to receive. Here is the journal entry to record the deferral. The transaction date for this entry will be January 1st, as that's when the payment was made. To record the deferral, XYZ Corporation will debit prepaid rent for $12,000. Prepaid rent is an asset that represents the right to use a rented facility in the future, an economic benefit that has already been paid for but not yet consumed. The corresponding credit will be to cash, reflecting the outflow of funds used to secure the rental for the next 6 months. It's important to note that no expense is recorded at this point. That's because the economic resource, the use of the facility, has not yet been utilized. This is precisely why the recognition of the expense is deferred until the benefit is actually received in future periods. In the next video, we'll continue exploring accruals and deferrals, this time using examples from ABC Clothing Company.